Welcome to lesson 2 of week 1, and in this session we'll be looking at definition of financial market terminologies. We'll be looking at different terms that are used in the financial market by traders. The very first term that we'll be looking at will be pairs. Using the Forex market as a case study, we would say that a pair in the Forex market is the combination of the two currency pairs you are exchanging. For instance, we have USD CAD, that is US dollar versus Canadian dollar. This is called a pair, right? That is to say that we are exchanging Canadian dollar for USD. Normally, for knowledge's sake, it is worthy of note that the currency at my left-hand side, that is the USD, is called the base currency, whereas the currency by my right-hand side is called the quote currency. All right? The implication of this is that the base pair is constantly 1, when the quote pair is the one that we are considering in exchange for the base pair. That is to say, we are looking at how many Canadian dollars do I need to get 1 US dollars? How many Canadian dollars do I need to get 1 US dollars? All right. Now, let me show us the different pairs that we have in the Forex market. Okay, now look at this, where we have the Forex, we have a lot of folders here, as you can see by my left hand side. Now let me click on the Forex market to see the listing of the currency pairs that we have. We have USD CAD, we have the USD CAD, that is Australian dollar versus Canadian dollar, AUD-CHF, that is what? Australian dollar versus the Swiss francs. All right, not just the AUD pairs, we have pairs like the Euro JPY, that is Euro versus Japanese yen, and lots of these currency pairs. As you can see, we have USD CNH, that is US dollar versus Chinese currency, USD CAD, SGDJPY, and so on and so forth. So this is what we call pair. When somebody wants to approach me like, what pair are you trading in the financial market or the Forex market? I can say, oh, I'm trading USD CAD, or I'm trading Euro USD. So that is what we call pairs in the financial market. All right. So the next term that we'll be looking at will be pips. Now, pips is an acronym that stands for percentage in points. Percentage in points. And yes, some persons call it price interest points. Price interest points. They are all the same. Okay? So I will just show you what pips is in the simplest language that you would understand it. Okay, in the Forex market, there is a language that says that pips pay the bill. Pips pay the bill, in the sense that what the amount of pips you are able to capture in the market is one of the things that determines the amount of money that you make. Just in a layman's understanding, I usually define pips as the distance moved by price. As simple as that, the distance moved by price. For instance, you can see on my chart, the pair that is currently on my chart is gold. You can see it here. XAU USD. XAU represents gold. Then I have US. That means I'm trading gold using US dollar. All right, US dollar. So the defining pips from this stance means you can see this movement from here to here. Okay, you can see the points that I marked. Now I want to check what is the distance from here to here. Just like you say, somebody walked from point 1 to point 2, okay? You will say that the person walked, say, 5 kilometers, 50 kilometers. In this case, you will say that the price has moved 10 pips, 20 pips, 30 pips based on your calculation. I don't have to start teaching you the mathematical calculation. What I will simply do is show you how to look at how many pips you have captured. Let's assume that I placed a trade from, I sold gold, that is, I placed a sell command from point 1 to point 2. And I'm like, I want to tell somebody, oh, today I made so and so pips. I can't tell people I made $100 or $200 or $1,000. No. But I can say I captured 50 pips. 100 pips is the professional language used to measure the distance that price moved for the currency pair that you are trading. So what I will simply do in order to check the distance from point 1 to point 2 is to go back and carry. I will still teach you how to do this, but quickly I will carry. What I use is my Fibonacci. I will use my Fibonacci tool. We are still coming to that, and I will check from this distance to this distance, right? If you look at the changing figure up to my left, you will see a figure as 167. 165 currently is fluctuating as my hand is fluctuating. 165. I'll pick the first two and say that what I captured 16 pips. All right, this is the place I'm talking about. For those of us, just watch here as I move my Fibonacci tool again. Watch this zone. Okay, the second figure here, watch it. Now, can you see? It's currently at 165. I will not pick the last 3 digits. I will pick just the first 2 digits. That is, I will say 16 pips, that I captured 16 pips today. Okay, if it is from all the way up, right, all the way up, that is here. Sorry, from here to here. Now, let me check it out. I will say that what? It is 39 pips. So that is how to calculate the distance moved by price or change in price. However you want to define it, change in price, the smallest unit of change in price. But my way of defining it is, well, just as distance is measured in kilometers, we measure price movement in pips. All right. So next is broker. The next term I will be defining is broker. Now listen carefully. A broker is simply a financial professional who executes your order in the market. Okay? The brokers execute orders in the market on behalf of the clients. In this case, you will need a broker. So you are the client of the broker. They are also known as registered representatives or investment advisor. Okay, they help you to execute your trade. They are like the intermediary. They are like the intermediary between you and the financial market, because you may not have the criteria, you may not have met the criteria to transact directly in the financial market. So you will need an intermediary registered, okay, to be able to trade the financial assets in the financial market. So you need a broker. And in our next class, by next week, in the week 2, we are looking at the brokers. Why you need a broker, we'll be discussing about brokers properly, and I will be showing you how to register an account with a broker, how to deposit money, how to transfer money from your wallet to your trading account, how to open a live account, as well as how you can withdraw your profits. Okay, but note that the broker that I will use for the sake of this teaching is not that I'm advising you to go for that broker. No, you make your choice. There are a lot of brokers out there. There are a lot of criteria you may consider while choosing a broker. So feel free to choose any broker you feel is trusted for your trading. All right. So the next thing we'll be looking at is leverage. The next term is leverage. Now, what is a leverage? A leverage is simply borrowing money from your broker in order to augment with your little capital so that you can maximize your investment in the financial market. Most brokers will give you 1:50, 1:100 leverage, 1:500 leverage. Currently, my broker started giving 1:1000 and even 1:2000 leverage. What is the implication of leverage in your trading business? For instance, you have $100. You have $100, for instance. Okay, if your broker gives you 1:100 leverage, what this means is that for every $1 you have, for every $1 your broker gives you $100. For every $1 of your capital, your broker gives you $100. So if you have $100, for instance, your broker gives you 100 times 100. So you are actually managing this amount behind the scene, even though your capital reads $100. So with the leverage, you can make more money, borrowing money from your broker. But note that leverage is two-edged sword. It can be to your advantage, it can also be to your disadvantage. So in a subsequent class, we will talk about how we can maximize leverage to our own advantage. Okay, so it's like a trap and it's also like a good thing, it's a good stuff, right? So leverage simply means trading with your broker's money. While registering a live account, your broker will ask you to choose. Do you want 1:100 leverage? They will show you the options. Do you want 1:500? Do you want 1:1000 leverage? Do you want 1:2000 leverage? Whatever choice you make stays behind the scene of your capital. The next term is stop loss. Now, one thing you must never do in the financial markets is trading without a stop loss. Just as the name implies, a stop loss is simply the tool that helps you to stop your loss when market goes against the direction that you anticipated. For instance, let me assume that I anticipated that that price is going to go all the way up from here and go all the way up. But as you can see, price is shooting down. Okay. Now, what if price eventually shoot down and go against me instead of going up to my favor? No problem. We don't lose capital in the Forex market because we took a wrong trade, but simply because we did not use a stop loss. One of the reasons is you did not use a stop loss. What do? I will put my stop loss right below here. What am I saying? I am saying that eventually, as I predicted, the market is going to go up, but eventually if market goes against me, what happens is this. Once market hits my stop loss, automatically my position is closed. And only that percentage that I exposed to risk will be what? Cut off from my capital. So stop loss is like your insurance, something that insures the other percentage of your capital while you are trading, so that you will not lose out on all your capital in case market goes against your decisions. Okay, so stop loss is a very important tool. In our classes as we move forward, I will teach us how to set your stop loss and where you should set your stop loss. So on the other hand, we have what we call take profit. That is the next term, take profit. It is the opposite of the word stop loss. Take profit or target profit. Target profit. Okay, target profit simply means the position you are targeting, target profit or take profit. Okay, the position you are targeting, the profit you are targeting. For instance, now I told us that if I place my buy entry here, I place the position here, and I'm now like, okay, the price of gold at this point is about $1,892. And I said, okay, I want to take my profit at this zone. That is my TP, is usually demonstrated as TP. I want to take my profit at this zone. What am I trying to say? When price eventually comes all the way up here, then I will take my money, I will take my profit. So you set this take profit here. I will show us how to set it in our subsequent classes. And the next time we'll be looking at will be market structure. I'll be combining this market structure with trend, what we call trend in the financial market. Now, before you place any trade, the first thing you must determine is what is the current market structure? What is the trend? Are we going up? Is price shooting up? Or is price shooting down? You must answer this question before you can determine whether you are buying or you are selling. Now, what is market structure? Market structure simply means the pattern of the market per time, the pattern of price movement, the pattern of price movement per time. For instance, is this price shooting down, as you can see here, or is the price shooting up, as you are beginning to see here, or is the price just moving this way in a wavy manner? And then what is trend? Trend is just another language for market structure, I should say. We have basically two types of trend in the financial market. What is the trend? Are we trending upwards or are we trending downwards? Here, we are trending downwards. Are we trading upwards? Here, we are trading upwards. Or are we trading sideways? Look at this. We say that what market has been shooting up. We're in a downtrend here. Here we are in an uptrend. And what is the next term that we'll be looking at? We'll be looking at the bulls and the bears. Financial market is usually taken to be a war zone, a battleground. Battle between the bulls, the animal bull, and the animal bear. So the bulls and the bears. Who are the bulls? The bulls are the buyers. When market is what? Going upwards or trending upwards, we say that what? The bulls are in charge. The bulls want to push price higher. The bears want to push price lower. So let's look at one more term. And the term we're going to be looking at now is support and resistance. Support and resistance simply means opposing force. Opposition. Let me put it like this. Opposition. There are areas in this chart that we call the areas of support and resistance, where price found it difficult to push forward or to push downwards. In an uptrend, watch this image. In an uptrend, when we are restricted, when price is being restricted from moving forward by a force, we call that force a resisting force. So what happens is that market will shoot down a little bit. This movement, a little bit down, is called pullback. Now I'm getting back on other terms, very, very important terms, pullback or retracement. I call it in my own terms, discount. Now, when this price is discounted or price pulls back due to resistance, it comes back and meets another resistance. But this resistance is now called support. This support supports it to now push all the way up above the resisting force. So that is what we call support and resistance. When price is shooting down, the previous support becomes resistance, previous resistance becomes support, as the case may be. Let me explain further. Watch this closely. Price was going down in a downtrend. We have been moving down, up, down, up, down, right? When price came here, something resisted it and it went back and found support that now helps you to push down. Now here was resistance, right? Mark the zone. Then after it pushed down and went back, this same place that was resistance now acted as support to help it push through. Now here, support. Remember, previously it was resistance. Now it is now supporting it to push down. And then we went all the way back again. Remember that when we came here, we were resisted, right? We are resisted. And then we pushed back and then pushed through. And then that resistance now acted as support. And then you see it now. So support and resistance zones are very important zones. We are going to delve into them properly when we move into the class subsequent weeks. But in the next lesson, I'm going to give a summary using a real life situation of how this works. See you in lesson 3.